Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Net Present Value, NPV, a simple guide to making smarter financial decisions. NPV also shines during project reviews. If cash flows fall short or exceed expectations, it's easier to adjust strategies knowing the financial impact. This makes planning not just smarter, but also adaptable to real-world changes. When used effectively, NPV isn't just about crunching numbers, it's about making informed choices that drive business success. Advantages of using NPV. Net Present Value, NPV, is a cornerstone in financial decision-making and investment analysis. It isn't just a calculation, it's a tool that provides clarity and confidence when deciding where your money should go. Below, we'll explore 2 major benefits of using NPV in detail. Clear measure of profitability. When making financial decisions, one question overshadows the rest: will this investment be profitable? NPV answers this directly by giving you a clear number rather than vague estimates or percentages. It calculates the net value an investment adds to your wealth after accounting for all incoming and outgoing cash flows, adjusted for the time value of money. Here's why NPV stands out. Quantifiable results. Instead of relying on guesswork, NPV provides a concrete dollar amount you can evaluate. If the result is positive, the investment is expected to add value. If negative, it likely isn't worth pursuing. Apples to apples comparison. Since NPV adjusts future cash flows to their present-day value, it allows you to compare multiple investment options on equal footing. This is especially useful when projects have different timeframes, costs, or returns. Actionable insight. A positive NPV doesn't just tell you a project has potential, it helps rank projects by profitability. This ensures your resources go to the option that delivers the most bang for your buck. Think of it like a financial GPS. NPV doesn't just tell you whether you're on the right path, it highlights the fastest route to reach your financial goals. Risk assessment. Investments often come with risk. What if a project doesn't generate the returns you expect? What if economic conditions change? NPV helps manage these uncertainties by factoring in the discount rate, a reflection of risk and opportunity cost. Here's how NPV helps with risk. Built-in safety net. By discounting future cash flows, NPV automatically lowers the value of uncertain or far-off benefits. This cautious approach prevents overly optimistic projections. Scenario testing. Adjust the discount rate to see how different risk levels impact profitability. For high-risk investments, a higher discount rate tightens the margin, showing a more conservative value. Prioritizing safer investments. Comparing NPVs of various options helps you identify which investments balance return and risk most effectively. Imagine investing in 2 projects, one with steady returns over 5 years, and another with high returns but greater uncertainty. NPV simplifies the decision by accounting for the likelihood of each cash flow actually materializing. This lets you proceed with confidence, even in uncertain markets. At its core, NPV doesn't just measure profitability, it ensures you're making choices that align with both your financial goals and risk tolerance. Limitations of NPV. Net Present Value, NPV, is a popular tool for analyzing investments, but it's not without its challenges. While it helps you make informed decisions, certain limitations can affect accuracy and reliability. Let's break down 2 key factors that often complicate its use. Dependency on forecasts. NPV heavily depends on cash flow forecasts, which can be tricky. Why? Because predictions about the future are always uncertain. Forecasting errors. Small mistakes in estimating revenues or costs can seriously skew your results. For example, underestimating expenses could make an unprofitable project look like a winner. Unpredictable factors. Economic changes, market demand, or unexpected costs can throw off even the best forecasts. Overconfidence in assumptions. It's common to overestimate future earnings, especially with optimistic projections. This creates a misleading NPV, one that may suggest a project is profitable when it's not. Think of forecasting as weather predictions. You might get close, but you can't control sudden rain or storms. Similarly, with NPV, the better your data, the more reliable your results, but there's always a risk of error. Choosing the discount rate. Selecting a discount rate may sound simple, but it's not. It's both subjective and influential, and even slight changes can alter the outcome significantly. Hard to pinpoint. There's no universal formula for picking the right rate. Should you use your borrowing rate, your expected return, or something else? Impact on results. A lower discount rate can inflate your NPV, making marginal projects seem profitable. A higher rate, however, might undervalue good opportunities. Bias factor. Personal or organizational biases can creep in. If someone wants a project to succeed, they might pick a favorable rate to make it look better. It's like adjusting the brightness on a camera. Too dim, and you can't see the full picture. Too bright, and it washes out important details. The right balance is critical, but deciding what's right often feels like guesswork. When using NPV, these limitations don't mean the tool isn't useful, they just highlight areas where caution is needed. Having clear, realistic inputs and acknowledging uncertainties can help you make stronger decisions. Alternative to NPV. While net present value, NPV, is a powerful tool for making financial decisions, it's not the only method available. Depending on the situation, other techniques may be more suitable or complement NPV to provide a well-rounded analysis. Let's explore two common alternatives. Internal rate of return, IRR, comparing NPV and IRR. The internal rate of return, IRR, is another widely used method for evaluating investments. It calculates the discount rate that sets the NPV of a project to zero. A higher IRR indicates a more profitable investment. While both IRR and NPV rely on cash flow estimates and the time value of money, they approach decision-making from different angles. Key differences between IRR and NPV. Interpretation. IRR expresses profitability as a percentage, while NPV provides a dollar value. Decision focus. NPV tells you if a project adds value, whereas IRR focuses on the return relative to cost. Usefulness. IRR is better for quick comparisons, especially when the discount rate isn't clear. Imagine choosing between two projects with different cash flows. NPV might favor one because of its higher total value, but IRR could rank the other higher due to its efficiency. This can lead to conflicting conclusions, especially for projects with uneven cash flows. When should you use IRR instead of NPV? IRR is ideal for comparing investments with similar scales or for stakeholders who prefer return percentages over dollar figures. However, it's less reliable when cash flow patterns are irregular or when multiple discount rates apply. Payback period. How it differs from NPV. The payback period is the time it takes to recover an investment's initial cost. It's straightforward. Calculate how long until your cumulative cash inflows equal your upfront expense. Unlike NPV, the payback period doesn't account for the time value of money. How it stands apart from NPV. Simplicity. The payback method is easier to calculate but less comprehensive. Focus. It prioritizes speed of recovery, while NPV measures overall profitability. Risk preference. It appeals to risk-averse businesses that value quick returns over long-term gains. For instance, if two projects require $10,000 upfront but one recovers the cost in 2 years and the other in 5, the shorter payback period may seem more attractive. However, this ignores the larger long-term benefits the second project might deliver. This is where NPV provides deeper insight. The payback method is great for screening projects when liquidity is tight or when you need to prioritize fast returns. But it should rarely stand alone since it overlooks profitability beyond the payback period and fails to adjust future cash flows for inflation or risk. By considering methods like IRR and the payback period alongside NPV, you'll gain a broader perspective on your investment options. Each tool has strengths and weaknesses, but together, they can help you make smarter decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.